If you guys ever wondered what it was like to be 3, 4, 5 years into an infinite banking whole life policy, stay tuned for this video because what I'm about to show you is really the back end of our client success stories. And I want to give you a real life example today of how one of our very close clients is utilizing their policies and how their policy looks today versus how it did when they first started the policy. And I want to show you guys from our perspective how we kind of want to understand and maybe reteach the infinite banking concept, because we all know sometimes you get really excited about a concept, really excited about a strategy, you implement it, you're loving it, you're just new investment you're doing, you're excited for, and then a year goes by, 2 years goes by, and you forget about it a little bit. Maybe you lose the enthusiasm you had towards that, or the excitement you had towards that investment or that thing. Well, that happens for a lot of people incorporating the infinite banking concept. Every single day, I hear people who are 2, 3 years into a policy saying, shoot, I forget maybe what this type of premium is, or I forget how I should probably use the policy for this situation. And everyone needs a refresher, right? So today, this is for you guys who have policies, you're deep into it, and you want a refresher. I'm going to use this specific client as an example for you guys, and I'm going to actually tailor this episode towards him, because I'm going to give this video to him directly, personally, and I want you guys to kind of see how I would communicate some of these ideas and re-emphasize some of these ideas for him. And you guys can take out of this what you can, hopefully incorporate some of these same ideas into your guys' practices. And those of you who don't even know what I'm talking about, this is your first time watching a video on our show, please go watch our main presentation. We teach the infinite banking concept, which is a strategy using life insurance as a banking vehicle. I'm going to go over a quick recap today, but if you don't know what this is, go watch our main presentation. You can find it in the link of this YouTube video. So thank you. Let's get into this. So I want to start by giving you a quick overview. When I was first learning about money, educating myself on investing and learning how to make money work for me, learning about the investment world, I had a question that kept popping up in my head, and actually others are bringing it up to me. And so I want to start with that question. The question being, could it be possible that there are more efficient environments to store wealth outside of commercial banks that we are not aware of? Okay. So what does it even mean? Well, look, every single day we all make and save money. And why do we make and save money? Because we're building that up so that one day we spend it. One day we invest it. One day we put it somewhere. Maybe we pay off a debt. That's literally what savings is for. So if you're saving with other banking organizations, is that the most efficient way for you to do it? The answer is no. And I'll talk to you here real quick about why. Well, what is banking? If you look up the actual noun definition of banking, what's banking? It's actually the business of protecting money. So who's going to protect your money better? You or Wall Street? You or Bank of America? You or Wells Fargo? You or JP Morgan? They don't care about you. They don't care about your money. They just want it. So they can invest it and grow for themselves. They're not in it to protect you. And some people will say too that those banks are FDIC insured, and that provides some safety. So there's a lot of protection in a bank account because it's FDIC insured. Well, I would counter that and say, would you lend money to somebody? Because that's really what you're doing when you're putting money with the bank. Would you lend money to somebody that you knew was in a enormous amount of debt with a very, very low probability of paying you back? No, you would not. You would never put your money with them or give them your funds. That's what you do with the bank every single day. They're FDIC insured, yes, but you know what that means? They're backed by the government. And guess what the government's in? Over 100 and whatever trillion dollars of debt. So I am not confident in storing money with a bank. In 2008 and 9, 364 banks went bankrupt. Guess how many of these mutually owned whole life insurance companies did? 0. They were actually profitable during those years because they're not backed by the government. So that means they can't just leverage money and lend money out to whoever they want at a massive ratio or at a massive leverage without any collateral and they can't just print money whenever they want. These insurance companies are private businesses that if they say they have cash, they have to have the cash on hand. So it's a private institution you're getting a policy with and you're trying to do banking with, and there's a lot more protection and safety in doing so. What is the verb form of banking? What's like the act of doing it? Well, the act of banking is protecting money actively, depositing money, and lending money constantly. So when you give money to a bank, they then leverage it and lend it out, making a profit off of your funds. If we just had a place where we could put money that was protected, we could deposit money there and then lend from it, we are now the bank. That is literally the whole concept of being your own bank. It's finding a place where you can do that. And it just so happens to be that whole life insurance is the most efficient vehicle to do that. So why do we use whole life insurance? Well, let's compare the attributes of whole life insurance to a traditional bank. Guess what? It's liquid. You have to have liquidity. If you don't have liquidity in your account, then you can't do banking with it. You can't leverage it. You can't feel confident to deposit money into it. So you need liquidity. And if you were to go get regular life insurance from a random insurance agent or from Dave Ramsey and his folk, you're not going to get any high cash value, any liquidity, because all of it's going to go to the death benefit. So we're very specifically designing these policies to do this strategy specifically. So it's liquid. It's also growing. The current company you have a policy with, John, is One America. One America, just to give you some context, they have been around for 149 years. They have been profitable every single year of their business existence, which means they pay dividends every single year. Historically, their dividends have been in the 7 to 8% range. This example here is just a hypothetical scenario of taking the average amongst a bunch of companies and whatever, but I say 2 to 5.5%. But these insurance companies that we work with are very strong companies. They're very profitable, and that's why they have high dividends, which means you're going to be getting growth inside of your policy every single year. A traditional savings account has 0.07% as the average growth rate amongst all the savings accounts in the market today. Sure, there's some more, sure, there's some less. But that money you have inside of the policy is growing at a guaranteed rate, uninterrupted and compounding interest. Those are very big words with a lot of meaning, but very important. Uninterrupted meaning it's never going to stop growing. It's not going to be interrupted because you're never going to pull money out and stop the growth. It's always going to continue to compound. And by having a policy and leveraging it, you take loans against your policy to access the funds. So that means your dollars continue to grow your whole life. Now, your policy also grows tax-free. A traditional bank is taxed. So tax-free growth. Actually, let's hit that one more second, a little longer. So I can show you the math. And One America last year, their dividend was 6%. After like all the administrational fees and cost of the policy and everything, I think the growth was like closer to like 3 or 4%. But let's just do the math real quick. If you're taxed at a 20% rate, okay, to get a 3 to 4% post-tax return, because that's what the policy is. It's tax-free, so it's a post-tax return. To get a 3 to 4% post-tax return every single year forever, that means you have to be getting like 5-6% in the market every single year forever, pre-tax, to actually match what life insurance can do. So people often talk about how bad the rate of return in life insurance is. I wouldn't disagree. It's not great. I can get way better returns in other places. But as a foundational asset, to have 3-4% post-tax growth forever, that's equivalent to a 5-6% pre-tax return in a money market account or a bond. It's actually pretty solid. And if you were to put money in a 401k or an IRA where someone else was managing it, it was a money managed account, there's going to be a 1 or 2%, maybe even 3% fee attached to it. So in order to have a fee, call it 1% or 2%, and have it be pre-tax, in a money market account, you have to be making 7-8% every single year forever to match what life insurance can do. Because the policy growth is post fees, post taxes, post everything, because it's all built into the product. So to actually get something equivalent to like a money market account, you got to be making 7-8% every single year forever to match life insurance, which people don't often talk about. But that's a massive reason on why we feel so confident to use life insurance as a savings vehicle. It's kind of a foundational asset because literally everything's guaranteed and safe. There's no volatility. Whereas all those other type of accounts do. You're not going to get 7-8% every single year, no matter what, in a money market account. It's not possible. So the compounding of this growth inside of a whole life policy is actually way larger than you would think. But what's next? Well, life insurance is protected. It's protected against lawsuits, judgments, liens, the market crashing, in some states, bankruptcy and divorce. So if you're talking about protection, there's literally no other asset that has this type of protection. Life insurance is so stinking safe, risk-free. It's awesome. And on top of that, it's stable. Like I mentioned earlier, banks go bankrupt all the time. These insurance companies don't. And on top of all of this, you have a death benefit, which I don't talk about a ton in all my videos and teaching this to people. But to have protection for your family in case something happens to you, massive benefit. If you were just saving money in a bank account and you passed away, they get nothing. You have a policy, they're going to get a multiple of what you've put into that account. They'll be getting hundreds of thousands, if not millions of dollars paid to them to help with the financial loss at that time. So death benefit is extremely important and kind of just built into this system. I know I don't have life insurance even on this slide. I build these policies and teach people to use these policies for the banking ability and the asset that it is, and not the death benefit. But to have that as a cherry on top is huge. So all that being said, let's transition here. Finally want to get to what I was going to try to show you the whole time. This is One America. This is your actual illustration. This was the illustration that we set up your policy with on day one. I did a horrible job of explaining to you how this policy works when we first met and how it's structured. So I want to kind of recap those ideas to you and teach this to you again. And those of you, again, watching this for kind of the first time or just wanting to get a better understanding of how these policies work over time, when you get your own illustration for your own policies, depending on the company they work with, they're going to look very similar to this, and they're going to have the exact same wording and attributes to the policy. So don't feel like this is just a One America thing. This is a all companies we work with kind of thing. So let's start with, I want to show you the original illustration and then the illustration up to date so you can actually see the difference. So the product is called Whole Life 121. It's with One America. It's prepared for John. Cut out his name for you. Let's see. So this is a 24-page PDF, kind of long, but it's not like the actual contract on the policy. It's just the illustration, the basic illustration showing you the numbers of the policy from what they projected on day one. This is a 37-year-old male at the highest health rating, just those of you who want to take this into account. If you're older, younger, healthier, unhealthier, that could affect how the policy works. And this person was paying, and John, you're paying $1,500 a quarter into the policy. So it's about, what is that, $6,000 a year into the policy. So those of you who save $500 a month, that's basically what this is, similar equivalent. And the first 10 pages of this illustration is called a narrative summary. It just kind of outlines for you the narrative format of the, I guess, the wording and the insurance terminology. So like, what's the policy? What's a death benefit? What's underwriting? What's premium? What's cash value? All these things that you probably already know about. We don't need to dive into those details, but I will highlight a couple things so you kind of get a gist of what I want to show you today. I want to highlight the very first sentence. They say that the Whole Life 121 is a participating whole life insurance policy. Stop. That means it is a participating policy. It participates in the dividends that the insurance company has every year. Okay. It also provides a guaranteed death benefit and guaranteed cash value. So right off the bat, this is what you know. Everything's guaranteed. There's no risk, no volatility. It's set from day one. That's why we feel so confident to use this as kind of a foundational banking and savings asset, or even comparable to like a money market account, a bond account, stock account. I would treat this policy better than all those other places. And the reason, again, I feel so confident with that is because everything's guaranteed, as this first sentence on the whole thing states. I'll skip through some of this. I mean, there is a terminal and chronic illness rider on the policy. There is no charge to have these things on there. So another benefit you don't get in any other type of savings vehicle is everything's guaranteed. or sorry, I just got distracted real quick. The policy is a terminal and chronic illness. So if you were to get some terminal or chronic illness in your life or have some sort of long-term care needs, the insurance company would actually accelerate the death benefit to you while you are alive. So there's that benefit as well inside of the policy, which I think is pretty cool. No, you don't get that anywhere else. But this is the meat. This is the piece I want to talk about real quick. Paid up additions. PUAs. This is a very special type of premium you can pay onto a policy that what it does is this. This is the definition. This is a type of premium that purchases paid up insurance. So it pays up or pays off, I guess you could say, the life insurance coverage. And because it pays off the insurance coverage, it's all guaranteed to be available to you in cash value. And cash value is what's inside of a whole life policy that you can access or tap into. It's your liquidity. So if any amount of money you pay towards the PUA rider goes straight to your cash value, that's pretty cool. If you were to go pay $1,500 a quarter in regular whole life insurance or term insurance or IULs, you would have no cash value for many, many years. The only way you have such high cash value in a policy, and the way we want to build a policy to do this strategy, is you need to have the paid up additions rider on the policy. So how does it actually look? Well, here's that breakdown for you. There's two types of premium on the policy. So every quarter you pay $450 a month to regular whole life insurance. Regular whole life insurance is what's buying the death benefit. It's what's going to give you all the guarantees of the policy kind of built into it. But this is what you could kind of consider the cost of the policy because it's paying for the death benefit. It will, however, though, give you cash value. It's just very long-term cash value. And this premium is what's fixed. So if, John, you lost your job or income was low or life was tough for some short period of time, you do not have to pay the full $1,500 a quarter. You only needed to pay the $450 a quarter, which is $150 a month, which I'm sure that would be easy to do for most people in America. $150 a month would be the minimum to keep the policy going, worst case scenario. However, this does not give you much cash value in the short term, but it will long term. And so that is one type of premium you pay on the policy. The rest of it goes to paid up additions. And what paid up additions do is it buys you immediate cash value right away. That's literally all it does. It's also optional premium or flexible, you could call it. So if at any point you did not want to pay into the policy, you would not have to. Okay? You wouldn't. This is not required, just the base premium. But if you do pay the PUAs, it does build your cash value and gives you more liquidity, has more money in there growing for you. So you do want to max fund your PUAs every year. Now, one thing I noticed, John, I almost said your name, while looking at this, was that you actually have more paid up additions you can do into the policy every year. So if I were you, I would try and max them out. If you are doing $6,000 a year in total, $1,700 a year in base premium and $4,200 a year in paid up additions, you probably could do another $300 a month in PUAs or another $3,000 a year. So this could be about $7,000 a year if you wanted to. So you have the option to put a little bit more into the policy every year than what this is set for. And if I were you, I would try and max it out, but just wanted to let you know you do have the option to do more. Now, let's keep going on this illustration though. And again, John, I'm going through this policy for you because I didn't do this the first time we met, or at least I didn't do it with enough justice. So this is why this is the point of me making this video, is really for you, John. And then I thought, oh, let's throw this on YouTube too and have others watch this and learn from this too. But really, I want to show you this because this is what you're setting up and what you're using for your family. And I think there's a lot of important things built into this that we haven't discussed. So anyway, going back through this, there is this is the illustration. This shows you the policy year and the age and how the policy grows over time. So you'll see it split down the middle, okay? And there's a guaranteed side and then there's a non-guaranteed side. The only difference between these two sides is that the guaranteed side is not including a dividend. The non-guaranteed is including a dividend. And the dividend with One America and every company changes each year based on their profitability as a company. So we can't always guarantee the dividend. That's why they have it as non-guaranteed. And I will tell you, when you look at these illustrations, built into this cash value, they are including the projected dividend every year. But these companies are extremely, extremely conservative. They are not here to wow you or give you some super high rate of return. They want to be super conservative and just give you the bare minimum to give you some ideas of how it could perform and grow over time. Now, you'll see there's a premium column, there's a cash value column, there's a PUA cash value column, and a death benefit. On this chart, they're showing you how much cash value comes from the base premium and how much cash value comes from the paid up additions premium. So how much comes from both types of the premiums you're paying on the policy. And you have access to both. They just separate it out for you here so you can see the difference of what comes from both types of premiums. So if you didn't pay the paid up additions, this cash value would not be as big. If you just paid the base, here's what it would look like. This total net cash value column over here includes all of it combined plus a small dividend. So that's what this is showing you, the growth inside of the policy. And then obviously the death benefits, what you're protecting your family with, which is $140K in year one, and it increases your entire life no matter what. So that's pretty cool. When you're 65, the death benefit's 340 grand. Nothing crazy, but always something to help protect you in case something happens. Cash value wise though, there's just one metric I want to look at. The cash value increase year to year, okay? So to show you that, you'll see the cash value is 4,000, grows to 8,200. So it grows by $4,200 and you put in about 6 grand. Year 3, you put in 6 grand. The cash value grows from 8,200 to 13,500. It grows by 15,300. So the cash value increases again by more. And it does that forever. There's actually a chart here at the bottom that highlights for you the change in cash value growth per year. So I want to show you that. This is the non-guaranteed illustration. You'll see the dividends you earn purchase paid up addition so that it reinvests back into the policy. You'll see a projected very small conservative dividend. And then you'll see total cash value, which is the same as the previous chart. And then you'll see the change in cash value. This I want to look at because it shows you the increase in cash value each year. So when you put in 6K, grows by 4. When you put in 6K, grows by 4,200. You put in 6 in the 4th year, grows by almost 6. So think about that. 4 years into this policy, you'll put in 6K, have access to pretty much 100% of your money. Next year, you put in 6K, you have access to more than what you just put into it. Put in 6K, you have access to more than what you just put into it. Put it after 10 years, I show you just paying the base premium and no more paid up additions. So if you just paid the base premium of $1,700 a year, the cash value increases by $4,000. So it doubles what you put into the policy that year alone, and it just continues to exponentially do that forever. So how I look at this is not as an investment, but as a savings vehicle. You have a savings vehicle that 3 years into it, you know you have access to less than what you put in every year, basically a cost. That's because you're buying a death benefit. After 3 years, okay, you now have a savings account that every dollar you pay into it, you have access to it or more. And it grows your whole life. And you have access to the more. You have access to all of this you can use. You actually could take these funds out and go invest it somewhere that produces a return, and you could refill it. So now after 3 years, you have a bank account that pays you more to have the account. You have a death benefit that's basically free and grows forever. So yes, it's the most efficient savings vehicle on planet Earth. And you can tap into this cash value every single year and use this money, and you would not stop earning a dividend. You would keep earning a dividend forever. You'd still have the death benefit. You'd still be growing on the policy. Nothing changes. You are just now using the cash value, taking a loan against this whole asset to go invest it or pay off debts or go use those funds elsewhere. Now, that actually banking of the policy, the usage of the policy is not actually shown on this chart. The usage of the policy, taking 20 grand out and going to go buy a rental that produces income and refills it. The appreciation you get there, the rate of return you get there, the tax benefits you get in that investment are not shown on this chart. So the actual usage of the policy makes all of this just better. So worst case scenario, you have a cool savings account. Best case scenario, you have a banking vehicle to finance things, invest in things while your money grows at the same time. So, long story short, I know that was a lot of information. I will say, I'm looking at your current policy. You are 3 years into it. I'm not going to show you it because there's too many things I'm trying to show you and teach you right now. So I just want to point this out to you that 3 years into your policy, it said your cash value would be $13,500 and it said your death benefit would be $169,000. Well, actually, as of this year, your cash value is $14,600. So $1,000 of growth more than they projected. And your death benefit's $173,000. So $4,000 of a bigger death benefit. If you actually want to look at the policy 10 years in, with their current projections, continuing with where they're at today, they project your cash value in 10 years will be at $62,000, where they project $6,800. They projected $270 is the death benefit. They project $276 is the death benefit as of the newer numbers, updated numbers. So again, this cash value and death benefit are really worst case scenario. This is what we told you would be getting. You end up having a higher cash value policy, a more death benefit policy, because the insurance company is being more profitable. They have more dividends they're paying than they are projecting. Infinite banking is a concept of banking, saving money in a place you could control, having more benefits, more growth than any other type of savings vehicle, and then leveraging it and lending against the asset to go invest and go purchase things, go bank with it. By using this strategy, you will receive and grow wealth at a much faster rate and have more accumulated long term than if you did not have this system. Because let's do the math real quick. Let's say you needed to buy a car for 15 grand. You're gonna go buy your daughter a car. You could take 15 grand from your policy and go buy the car. Or let's say you saved up 15K in a savings account and then you went and bought that car. Well, if you did that, if you saved 15 grand up and went and bought that car from a savings account, you just lost 15 grand. You lost the ability to earn and grow and compound interest on that 15 grand because you spent it. Whereas in the policy, if you take a loan against your policy to buy the car cash 15 grand and then pay your policy back $300 a month or whatever the car payment would have been, you're now the bank. You're now paying yourself back, and all of the 15K that you spent to buy the car was not gone, not spent. You didn't have any loss of opportunity interest on that money. That money is still inside of the policy, still earning dividends the rest of your entire life, compounding forever, and you just bought the car. If you apply that same math to every financial transaction you ever make, anytime you pay taxes, anytime you buy a rental, anytime you pay off a debt or purchase something for the family, vacation, every time you spend that money, it's gone. But by running it through a system like this and do banking with this, everything will continue to grow forever. Now, your savings doesn't look like it's growing and then spent, growing and then spent, growing and then depleted. You're never going to build wealth by saving and spending, saving and spending. Your account's always going to be at zero. How you build wealth is making money multiple times, saving what you can, and letting it compound forever. That's building wealth. And then leveraging this asset to pay for the things you need in your life. So now you're saving, growing, and spending at the same time. That's the whole concept. That's what we're trying to implement. If you want to compare the policy to other investment vehicles, savings vehicles, we definitely can talk to that further. I'll probably make another video on this actually for just our followers and community about that. But I hope this was impactful to show you how we look at these policies, kind of re-emphasize those ideas of why we structure them the way we do, teach you more how your policy, John, is set up, and those of you watching how this guy was setting up his policy and using it to do his family banking. Thank you guys for watching this. This was much longer than I wanted it to be, so thank you for staying along if you did. Appreciate you guys, and if you please support this channel. If you want to learn more about this concept and you want to share this more with your family and friends, send this link to everybody you know. Teach them this concept because they can incorporate this just as much as you can. And everyone needs better savings, better banking, better investing. So teach this to those around you. Give us a follow and subscribe if you can, and then we'll see you in the next video. Thanks, guys.